Hey everyone, it's Caroline here with the Juniper Links Accounting channel. Today we're going to go over how to calculate income tax and national insurance. I will go through some actual examples of how to do this so you can have a really good idea of what tax you're going to pay at the end of the year. So without further delay, let's jump into my computer and get started with the video. Alright, we are in my computer and we're going to go over how to calculate income tax and national insurance for the 2021 tax year. So first things first, what is income tax? So this is just a normal tax on personal income that the government sets. Generally, these do not change, so it's very rare that this changes. So tax rates change based on thresholds, and that's essentially the level of income you receive during the year. So depending on how much income you receive, there are different tax brackets, and within each bracket you get a certain amount of tax charged. Most taxpayers will have 20% and 40% deducted from their pay, and this amount of tax is charged on salary, property income, self-employed income. Dividends has its own tax rates, but they have the same tax thresholds, so I will explain exactly how that works in a second here. And yes, Scotland has its own tax rates and thresholds, and also Wales is allowed to set their own rates. Currently they're the same as England though, so this should apply to anyone in Wales as well. What is national insurance? So these are contributions towards state pension and benefits, and these are generally a much smaller percentage than income tax, and often they drop off the more you earn as well. So for example, once you reach the higher rate tax threshold, all the income after that point, you only have 2% national insurance deducted. And you also have multiple forms of national insurance. So for example, this would be employees national insurance, which is generally what you'll be paying as an employee. There's also employers' national insurance, which most employees will not ever see, unless you're going through an umbrella company and they basically make you pay the employer's portion as well. Also, there are rates for self-employed national insurance contributions, which are separate to regular income. Other thing about national insurance is that you will stop paying it after you reach state pension age. So tax continues depending on the tax rates for the year, but national insurance deductions would stop. Now we'll start getting into how to actually calculate your tax liability for the year, including national insurances and normal tax rates depending on what form of income you receive. So for the 2020/21 tax threshold, that's up to the year ending 5th of April 2021, the personal allowance is £12,500. So this has no tax. It's like a tax-free allowance, and it's given to everyone as standard, unless you have over £100,000 income during the year, which is when it starts to drop off. Once we get the 12,500 out of the way, then we've got the lower rate tax threshold, which runs up to £50,000. And generally you have 20% tax on this, and that's tax on salary, self-employed income, property income, all of those sorts of normal income forms. The dividend tax on that, so I've set out dividend taxes here. So in the lower rate threshold, it would be 7.5% instead of 20%. So I will point that out. And basically any dividends are added after salary, property income, self-employment income, all those sorts of things. So they'll generally be taxed closer into the higher rate tax threshold. They'll be the first thing that reaches the higher rate if you're receiving extra dividend income, because they're always taxed last in the calculation. Moving on to the higher rate tax threshold is £50,000 to £150,000, and that's 40% tax. That's on normal income again, like salary, like self-employed income, like property income. For dividends, the higher rate tax threshold is 32.5%, and the upper rate threshold is £150,000 or more, and that's 45% tax on regular income forms and 38.1% tax on dividends. These tax rates for dividends only come into effect after the £2,000 dividends allowance has been taken into account, and the initial £2,000 that you receive in dividends for the tax year basically does not have any tax. It does use up the tax threshold though. Alright, let's get into the national insurance rates and thresholds for 2020/21. The primary threshold for national insurance is essentially the amount you can receive for the year before any national insurance is deducted. And this is the annual threshold. So there are monthly thresholds, there are weekly thresholds, depending on how you're paid. Then we have, so this PT stands for primary thresholds, and this UEL stands for upper earnings limit. So between the primary threshold and the upper earnings limit, you've got these amounts. This is the primary threshold, and this is the upper earning limit. And you'll notice that they are basically the same as the they're basically the same as the higher rate tax threshold for regular income tax is the upper earnings limit. So between these two amounts, there would be 12% employees' national insurance deducted from your pay. And this is on salary income primarily. Property income and self-employment income is something different. Property income doesn't have national insurance tax on it. Self-employed income does have national insurance at 9%. Similarly, dividends have no national insurance as well. And then you've got the final threshold, which is above the upper earnings limit. And this here is anything after £50,000, and you'll notice the national insurance rate drops down to 2%, and this is the same for both self-employed and employed people. Self-employed also has Class 2 national insurance, which they were supposed to get rid of, but they never did. But for now, it's still in place. So if you earn, there's a small profits threshold of £6,475. Once you hit this threshold, you have £3.05 weekly national insurance. This isn't paid weekly, it's just done on your self-assessment, so they'll just calculate how long your self-employed trade was during the year. So if you did a full year's worth, then you just do that times 52 weeks, and that's your national insurance. Obviously, if you're doing your self-assessment form, it'll calculate this for you. But for example, if you finished your trade early and closed down your self-employed business or your sole trader business, then it would just be calculated based on the number of weeks you were actually self-employed for during the tax year. Okay, so here is an example of an employee receiving £60,000 worth of salary and £1,500 benefit in kind. And let's say they've also got income from self-employment of £2,000 because they're an overachiever. Okay, so to get this calculation started, of course, the salary would be taxed through PAYE. In this case, £60,000 salary is already in the higher rate tax threshold. And if we add in the benefit in kind together, plus the self-employed income, it would look something like this. So first, let's sort out the tax. So since the income is still underneath £100,000, we have a £12,500 personal allowance for the year with no tax. Up to the £50,000 threshold, we have £37,500 income at 20%. So that would be £7,500. And then we've got £10,000 remaining from that salary, which would be taxed at 40%. We've also got a £1,500 benefit in kind, which would be taxed at 40%, because we've already used up the lower rate tax threshold. As you can see, this here adds up to £50,000. Everything further than that is higher rates. So finally, we would add in the £2,000 self-employed income, and it would also be taxable at 40%. So we've got a lot of amounts here. Okay, so we have a total tax bill of £12,900, and this is just the tax element of this. Okay, next we need to calculate the national insurance. So if your salary did come from one employer, then we would have the total value of the salary plus the benefit in kind for national insurance. The employee's national insurance threshold is £9,500, which has nothing. So as 0%. And there will be some fluctuations to this because remember that these are based on annual thresholds, and with monthly payroll, you can have some differences in the deductions. The remaining 40,500 up to the £50,000 threshold. So again, these here add up to £50,000. And up to that point, you would have 12% national insurance. Your employer would, of course, be paying different national insurances here at 13.8%. So any salary above that £8,788 threshold would have 13.8% national insurance. But that's something your employer should be paying, so it should not affect your tax liability whatsoever. And the remaining £11,500 would be taxable at 2% because the national insurance does drop off after this point. So let me just separate these a little bit. Make it a bit clearer here. And so for the national insurance on your salary, you'd be looking at a rough amount of £5,100 for the year. The cool thing with self-employed income is that it does have its own threshold. So for national insurance, rather than using the existing £9,500 that we've got for salary, the self-employed income has its own £9,500 threshold, which means since it's only £2,000 of self-employed income, it would have no national insurance. This is pretty much the entire calculation here. Self-employed would only have the tax liability, but it wouldn't have the national insurance deductions because the income is so low. So there's one example of just receiving normal income plus some extra income on the side. Your employer would have to pay employer's national insurance on both your salary and your benefit in kind. So if you're running your own limited company, keep that in mind. Alright, here's a second example where it's just a single director receiving a salary up to the employee's national insurance threshold and also receiving dividends into the higher rate tax threshold. The first step is to calculate tax on salary, and of course, since you've got a £12,500 personal allowance, the salary basically does not have any tax whatsoever. The remaining personal allowance of £3,000 can be apportioned to some of your dividends, which also has no tax. And then, in addition to this remaining personal allowance, your £2,000 dividend allowance is still added in there with no tax. Okay, so far we've used £5,000 worth of dividends. The remaining £35,500 in the lower rate tax thresholds for dividends would be taxable at 7.5%. All of this, again, is just the lower rate tax thresholds of £50,000. And if we add up all the dividends that we've already taxed in the appropriate thresholds, we get £40,500. So the remaining value of £10,500 would be taxable in the higher rate tax threshold, which has 32.5% tax. And remember, this is just the personal tax portion of your income. If you are running your own company, of course, dividends can only be taken when there's company profit available after corporation tax. So this means they've already been taxed with 19% corporation tax. Let me add up these figures for you. Okay, so you're looking at total tax of about £6,075 on this entire calculation here. And remember, I did say about the employer's national insurance, so that would be payable after receiving £8,788 in salary. So if we take the difference of that and the salary, we get £712. And on that £712, you have 13.8% employer's national insurance, which would be £98.26. So it's not a very large amount there for the entire years with the salary. Dividends have no national insurance, but again, they do have corporation tax already deducted from this income from your business because they can only be taken after tax from profit. Alright, a note on over £100,000 of income. This is very important because once you do reach £100,000 of income, you start losing your personal allowance. So this means for every £2 over £100,000 income, you lose £1 of your personal allowance. So on that basis, we can assess that once you reach £125,000 of income, your personal allowance is essentially gone. There's nothing left. If we look at the calculations from before where you had the personal allowance and then you had that £37,500 amount up to the high rate tax threshold at 20%. So when you go over this £100,000 income, rather than changing this here to 20%, which would be the logical thing to do, at least from my perspective, it makes sense if that would happen. That doesn't happen at all. It basically just gets deleted completely. And what that means is that you still get $37,500 at 20%, but that income that was previously using up the personal allowance is now going to be taxed in the higher rate tax thresholds, because you only get this $37,500 in the 20% tax bracket. So yeah, the income's basically gone and would be taxable in either 40% or 45%, depending on your other income. So be careful of that because it can significantly increase your liability. Okay, another thing I wanted to quickly go over because this can be confusing, they are payments on account. So HMRC asks for two 50% prepayments of your current tax liability to go towards the next tax year. And this only happens if your self-assessment liability, specifically tax, is £1,000 or more. So if you, for example, had a large student loan to pay, but your actual tax liability for the year was only £800, then there wouldn't be these payments on account, so don't worry about that. But where your tax liability is £1,000 or more, HMRC thinks you'll earn the same amount, if not more, next year. For example, if your liability was £1,000 for the current tax year, so the one ending in April 2021, HMRC would want you to pay £500 in addition to the £1,000 liability, and another £500 later on. So these first two payments here would be the normal deadline of 31st of January. The second payment here would be 31st of July, about 6 months later. And you can actually reduce the payments on account, or you can remove them completely if you know your income will be lower. Just be careful of doing that, because if your income does end up being higher than what you estimated it to be, HMRC will charge late payment interest on the payments on account, or the difference between your estimate and what the actual tax was, because these are the actual new deadlines for the payments on account and your tax liability for the following tax year, which means if they're not paid by these dates, then they are considered late, even though technically it wouldn't be due until the following January. So it's a little bit awkward, I know, but just do keep that in mind. If you will have a larger tax liability, then you would have payments on account, and they're 50% each, plus the normal tax that you need to pay for the year that you just did your self-assessment for. Alright, so that pretty much wraps up the video. Before I go, there are some helpful links here in the description below, as well as on this screen here. So the first link is for national insurance contributions. The next link is for income tax rates, and this is for just normal UK tax rates. And then the Scottish income tax rates can be found here, and these are very slightly different, but generally follow the UK's tax rates. They just have extra thresholds in there. Dividends are the same for Scotland and England, so generally the whole of the UK has the same dividend tax, so they haven't changed those or the thresholds. Alright, thanks so much for watching the video, and of course, as always, if you do need an accountant, feel free to email us at hello@juniperlinks.com. We primarily work with limited companies or those who are running their own limited company and would like to basically stay tax efficient during the year, get help with how much they can take from their company, and also general advice and guidance on allowable expenses and what HMRC expects you to do versus actual law and legislation, so we will go through all of that with you. If you've got a question regarding this video, then leave a comment below and we'll get back to you as soon as we can. And don't forget to subscribe for more videos like this, and feel free to click that notification bell to get reminded every time we upload a video. Thanks again for watching, and I hope you guys have an amazing day.